In this example, we're going to talk about acquisition costs for a non-interest bearing note. On January 1st, 2011, the Farmington Corporation purchased a packaging and labeling machine. Farmington paid $25,000 down and signed a non-interest bearing note requiring a $55,000 payment to be made on December 31st, 2013. The fair value of the machine is not determinable. An interest rate of 8% properly reflects the time value of money in this situation. And we want to prepare a journal entry to record the acquisition of the machine, and we're going to round that to the dollar. And then 2, how much interest expense will the company include in its 2011 and 2012 income statements for this note? Well, first thing, we know we're going to have to do an entry, we know we're going to have to debit the price of our machine. So we're going to have to calculate the price of our machine since the fair value hasn't been given to us. We also know that we're going to be paying cash, and we also know we have a note payable that we're going to have. So the couple things that we can determine real easy, we know how much cash we paid down, $25,000. So we're going to have a $25,000 credit to cash. We also know that we have a face value of the note of $55,000. Okay, so therefore, we've got the value of what we're exchanging. So we're exchanging $80,000. Now we need to determine how much of that is going to be allocated to the machine, and since it's a non-interest bearing note, how much is actually our discount on our note payable. So what we need to do is calculate our present value of our note payment. Okay, and so we are going to use our present value of an annuity. Okay, so present value of $1, excuse me, present value of $1. So you can look that up on your table, but I will save you the time and say it is equal to 0.79 383. So that's our present value of $1, and we're going to discount that 55,000 note. So the value of my note is 43,661. Okay, so that is going to be our value of our note. So then next we're going to determine what the value of our machine is. And so our value of our machine is going to be equal to our 25,000 cash that we paid, and then we are going to add the value of our note, our 43,661, our discounted present value of the note. So I'm going to put that over here, column. So my debit to machine, or the machine value, is going to be 68,661. Okay, the difference, we know our account has to balance, so it's going to be equal our 80,000 total given, and the value of our machine is 68,661. So my discount on note payable is going to be 11,339. So that's going to be my journal entry. Again, we're allocating what part of our entry is for the cost of the machine, and what part of it is the discount on the notes payable, because it's a non-interest bearing note. For our second one, we need to calculate our interest expense for 2011 and 2012. Okay, so we're going to do that by taking our discounted note of 43,661 times our interest rate of 0.08, and that's going to give us $3,493. And we'll format that little guy. Okay, in our next example then, my value of my interest cost is going to be starting with my 43,661, but then I need to add my interest. So basically it's compounding. Okay, so 3,493. Then take that times my 8%, and that's going to give me a value of $3,772. So that's what's going to be included as interest expense on my income statement related to that note. So we have to compute that. Actually, even though we don't have the interest rate does not have a stated value, but there is the time value of money, and that's what we do. Thank you for your time.